Here's how you can buy a home with as little as a 3% down payment and credit scores as low as 620. It's called conventional financing. And in today's video, we're going to walk through the 2023 conventional loan requirements to see if you can qualify for a conventional loan. On top of that, we're going to walk through the pros, the cons of conventional loans. We're going to answer some commonly asked questions around conventional financing. And lastly, we're going to compare it to FHA. How does it differ from FHA so that you can make a decision as a first-time home buyer which loan program is right for you? Now, I want to start today's video by actually talking about credit score. Credit score is one of the most important pieces when it comes to qualifying for a home, because not only does your credit score determine whether or not you can qualify for a loan, it also determines the interest rate that you get. And that interest rate ultimately determines your monthly payment. So I want to start with credit score because I feel like it's one of the most important pieces of conventional loans. And on top of that, there were some changes from last year in how lenders use your credit score that can make it easier for first-time home buyers to actually qualify for conventional loans. So with that said, FHA has a credit score requirement of a 620 credit score, which means that you need at least a 620 credit score as a single borrower in order to qualify for a conventional loan. Now, why did I say a single borrower? Because one of the changes that has happened with conventional loan guidelines is the fact that if there's more than one borrower on the application, say you're purchasing it with a spouse or a significant other, you can actually average the two credit scores for eligibility purposes when it comes to qualifying for a conventional loan. Now, what do I mean? Well, as a borrower, you typically have three different credit scores. You have a credit score coming from Experian, you have a credit score coming from Equifax, and you have a credit score coming from TransUnion. Typically speaking, a lender will use the middle of those three scores, not the average. So let's say, for example, you had a 700, a 650, and a 600 credit score. The lender is going to use the 650 to determine whether or not you're eligible to use conventional financing. So if you were a single borrower trying to apply for a conventional loan on your own and you had a credit score lower than 620, the lender would say you're not eligible to purchase using conventional financing. But with the changes in those guidelines, the way that it works now is, let's say that one borrower had a credit score of 700 and the other borrower had a credit score of 600. So normally that person with the 600 would keep you from being able to qualify for that home because the lender takes the lower of the two credit scores. But with the changes, they actually average those two. So between the 700 and the 600, the average is 650. So now for eligibility purposes, that's higher than the 620 requirement. That now means these borrowers are eligible to use conventional financing. And this is a huge plus for those out there that have lower credit scores. But the downside to this requirement is that for pricing purposes, for interest rate purposes, they're still going to use the lower of the two borrowers' credit scores. So in this case, the borrower has a 600 credit score, so the lender's actually going to use that 600 for pricing purposes, which means the interest rate is going to be higher than it would be if both borrowers had higher credit scores. Now, one thing I want to make very clear in this video is that you should always consult with a professional mortgage lender before determining whether or not you qualify for a loan. If you're looking at your credit scores thinking, well, my credit score is lower than 620, our average is lower than the 620, we don't qualify, we're not even going to pursue this, stop right there and take the time to call a lender, have the conversation, because sometimes the credit scores you're pulling versus what the lender's pulling are going to be different. On top of that, guidelines change, different things change. So make sure you're starting by having that conversation with a lender to determine whether or not you can qualify versus trying to figure it out on your own. Now, if you need a lender and you're not sure where to start, do me a favor. I put a link in the description below of people that I know, like, and trust that I know will guide you through the process and take great care of you. The second thing I want to talk about in today's video is down payment. Conventional guidelines only require a 3% minimal down payment. Now, there's a lot of myths out there that you need 20% down to buy a home or that you need this big down payment in order to qualify for financing, and that's simply not true. Conventional guidelines allow you to purchase with as little as 3% down. So if you're buying a $100,000 home, that's only $3,000 down. $200,000 home, $6,000, $300,000 home, $9,000, and you can do the math up from there. Now, one thing I want to be very clear on with regards to the 3% down payment is that by putting only 3% down, the guidelines are more strict than say if you're putting 5% down or 10% down or 20% down. The more money you put down, the higher credit scores you have, the more flexible the guidelines are with regards to conventional financing. So if you have low credit scores, you're putting very little money down, it's going to be hard to qualify for conventional financing, even if you meet all of the requirements, which we talk about today. And that's where the flexibility of a program like FHA can come into hand, because they have more lenient guidelines with regards to qualifying. They allow you to use more of your monthly income towards debt, and they also allow lower credit scores. So that's one of the benefits to using FHA. But typically speaking, conventional loans are going to offer better terms, assuming you meet the qualifications, the guidelines. So by putting just 3% down, you're going to end up with a higher credit score. You're going to end up with higher mortgage insurance. And oftentimes, the payment actually might be higher than that of an FHA loan when doing the minimal down payment. So just make sure when you're talking to that lender that we talked about earlier, you're getting them to compare both programs for you. You're getting them to run the programs side by side so that you can look at the payments for both to figure out which program is best for you. Now, do me a favor before we dive into the next guideline, hit that thumbs up if you're finding any value in today's video, and hit that subscribe button to stay updated on everything real estate related. Another requirement that conventional loans have is that you have to have mortgage insurance on your loan when you put less than a 20% down payment. So anytime you buy a home and you put less than 20% down on that home, the lender is going to require mortgage insurance. What is mortgage insurance? It's insurance that the lender takes out to insure themselves against you defaulting on the loan. So if you defaulted on the loan, that insurance actually covers them, right? So that they're not taking a loss on you not making your payments. And the reason they do this is because when you're putting less than 20% down, they see you as a higher risk, and they're more or less just trying to protect themselves. So conventional loans, you're going to have mortgage insurance. Now, oftentimes you'll be talking to a lender and they'll say, well, we have a program where you don't have to put 20% down and there's no mortgage insurance. Just understand there is mortgage insurance. It might not come in the way of an additional fee that you see on your statement every month, but it's likely built into the interest rate. You're getting a higher interest rate on that loan because you're putting less than 20% down. It's just reflected in a different way. So whenever a lender tells you there's no mortgage insurance on the loan and you're putting less than 20% down, run. Find a new lender, because what they're doing is they're trying to make it seem as if they're giving you some great product or some great loan, when in fact they're just charging you in a different way. Now, one of the commonly asked questions that I hear a lot surrounding mortgage insurance is, how soon can I get rid of the mortgage insurance? When does it fall off? Well, when you have 20% equity in a property, say you bought a property and you put 10% down, and since you've owned that property, you've gained 20% equity in that property. Well, you can call your lender and ask them to do an automated valuation on that property, an appraisal, if you will. And if it shows that you have the equity in the property, oftentimes your lender will drop the mortgage insurance on that loan. Now, understand, sometimes there's a minimum requirement that you have to have mortgage insurance on that loan for at least a year before the lender will drop it. In that case, you could potentially refinance out of that loan into another conventional loan. Assuming you have the equity, then that mortgage insurance should fall off. But if you're just sitting there waiting for the lender to just drop it, for it to fall off automatically, the lender is not going to do that until you're showing at least 22% equity in that property. So once you think you have that 20% equity, you either want to think about refinancing and or calling your lender and trying to get it taken off. Now, as many of you know, I'm a real estate agent, not a mortgage lender. I do these videos to provide some transparency, to provide some accurate information that you can use, where you're not feeling like, somebody's trying to sell you something when it comes to, loan qualifications, loan guidelines, what have you. But with that said, I have taken the time to walk you through the full process of buying a home. So if you're a first-time home buyer wondering what the process looks like, where do you start, what do you do, I've created a first-time home buyer course that I'd like you to check out in the description below. It's called Becoming HomeWise. It's actually an A to Z course on buying a home. It'll take you through the entire process of finding a lender, finding a real estate agent, writing offers, negotiating, everything you need to know. So do me a favor and check it out below. Now, the next thing we're going to talk about is debt to income ratio. Conventional guidelines are a little bit more strict than any of the other loan programs out there when it comes to debt to income ratio. Now, if you're watching this wondering what is debt to income ratio, it's the amount of debt from your income that you can use every single month towards your housing expenses, towards your credit cards, your student loans, your car payments, all of that stuff taken into consideration. And conventional guidelines have a cap of 43%, which means that you can't use more than 43% of your gross monthly income towards the expenses that we mentioned a moment ago. But understand, there's some flexibility with that. Oftentimes, you'll get approved at a 45%. If you have really good credit scores, if you have a larger down payment, I've seen it go up as high as a 49.9% debt to income ratio. But the way the guidelines read is it's 43%. So let's do a quick example here. Let's say you make $120,000 a year. That's $10,000 per month. The way the guidelines read is that you couldn't use more than $4,300 of that $10,000 towards your mortgage payment, the property taxes, the insurance, the PMI on that loan, any car payments you have, any credit cards you have, all of that combined is how they determine your debt to income ratio. So if you're watching this trying to figure it out, it can be difficult if you're not familiar with the process. I'll again ask you to speak with a lender, have that conversation instead of trying to figure it out on your own. I see too many people too often trying to do these calculations on their own when they can just call a lender and have a conversation. It's free. It doesn't cost you anything to get pre-approved. So instead of trying to figure it out, make sure you're talking to a professional. Now, this is one of the biggest differences when it comes to conventional loans versus FHA loans, because FHA allows you to use more of your income towards debt. They actually have more lenient guidelines. Instead of that 43% max, I've seen FHA loans go as high as a 57%. So it's a little bit easier to qualify for FHA loans than it is conventional loans. So if you're going through the process and you're trying to qualify for conventional and you're not qualifying for whatever reason, make sure you're checking out FHA, as that might be another viable option for you. Now, one of the biggest differences in conventional loans versus an FHA loan, on top of the debt to income ratio that we just mentioned, is that conventional allows you to purchase a primary home. It will also allow you to purchase a secondary home, and it will also allow you to purchase an investment property, where FHA will only allow you to purchase a primary home, a home that you plan to live in. Now, here's the caveat. When you're purchasing, a second home or an investment property using conventional financing, you're not going to be able to do that 3% down payment that we mentioned earlier. It's going to require a larger down payment. Typically speaking, an investment property is going to require 20 to 25% down, whereas the primary home is only going to require that 3% down payment. Now, one of the questions that often comes up is, can I purchase a home as a primary home, just put that 3% down payment, and then turn it into a rental at some point in the future? And the answer is yes. And people say, well, what's the time frame? Do I have to stay in there a year? Do I have to stay in there 6 months? There's actually not a written rule when it comes to this, but typically speaking, you probably want to be in the property for about a year as your primary home before you turn it into an investment property. And another question that comes up is, well, once I turn that into an investment property, can I then purchase another property as my primary home with conventional financing with just that 3% down payment? And the answer is yes. You can use conventional financing as many times as you want. You can buy as many homes as you want with that 3% down payment, as long as they are primary homes. Now, the next requirement I want to talk about with regards to conventional financing is income and employment. How long do you need to be on your job? How much money do you need to make? And the answer is, there's no minimal amount of money that you need to make. There's no max amount of money you can make. You can make $1 million a year and buy, with a conventional loan, putting just 3% down, or you can make $50,000 a year and buy with a conventional loan, putting just 3% down, assuming you meet all the other qualifications. But what's important with regards to income and employment is that it's consistent, which means that they typically want to see you in the same line of work for a consistent 2-year period. Now, that doesn't mean that you couldn't have changed jobs. That doesn't mean that you couldn't have gotten laid off and gotten a new job. They just want to see some consistency during that period of time. What they don't want to see is that you went from being a wage earner, an employee of someone else, to going out and starting your own company within that same period of time. If you're a self-employed borrower, they want to see that you're self-employed for 2 years. If you're a wage earner, an employee of someone else, they typically want to see that you're a wage earner for 2 years. And the same thing goes for income. You want to show consistent income. If you make $50,000 one year and then the next year you make $10,000 and then the next year you make $30,000, they're going to look at that as inconsistent. But if you're making $50,000 the first year, the next year you make 55, the next year you make 60, well, that's consistent. It's consistently going up. It's consistently staying at that baseline that you started with. And in that case, you should meet the requirements for income and employment. And one of the last requirements I want to talk about today is assets. With conventional financing, you typically need to have some money in the bank. Now people go, well, how much money do I need? Well, it depends on a couple of different factors. It depends on how much money you're putting down. It depends on what your credit scores are. The better borrower you are on paper, typically speaking, the less money you actually have to verify when it comes to being able to buy that home. Now, I know that seems crazy, but when you have lower credit scores, you're putting less money down. The bank actually wants to see that you have some money in the bank outside of that down payment, outside of that closing cost, so that you can qualify for that loan. Now, again, there's no hard written rule on this, but you typically need at least 2 months of your PITI in reserves, which is your principal, interest, taxes, and insurance. Now, this is one of those guidelines that, again, isn't a hard, fast written rule. So you want to make sure you're talking with the lender, having that conversation, because I've seen people qualify that have very little money in the bank, and I've also seen people qualify that have a lot of money in the bank. It really depends on, again, your credit scores, how much money you're putting down, and maybe some other non-compensating factors that you may or may not have that will determine how much money you need. But typically speaking, you're going to need to show some money on top of your down payment, and your closing costs in order to qualify for conventional financing. Now, before we dive into the last loan requirement with regards to conventional financing, I want to address one of the commonly asked questions that comes up with regards to buying a home and qualifying for a loan and all that stuff. And that's, where do you get a loan? Where do you start? Well, you can go to your bank. You can go to a local credit union. You can go online and try to find a lender. I would typically start with a referral. If I were you, find somebody that's had a good experience, find somebody that you know that's bought a home, they've trusted the person that they've used. Start there, because what you want to do is make sure you're working with a professional, not somebody, not a kid in a call center that was doing a different job, 2 weeks ago and now they're doing loans. You want to make sure you're dealing with somebody that understands the business and can guide you through this process. It's an extremely important process. You're putting a lot of money to buy a home, so you want to make sure you're getting accurate information. So if you don't have one of those referral sources, you're not sure where to start, I've taken the time to put a link below of people that I know, like, and trust that will guide you through that process. So make sure you check it out if you're trying to buy a home and not sure where to start. Now, the last guideline I want to talk about with regards to conventional financing is that they have a max loan amount when it comes to buying a home. They're not just going to lend you some unlimited amount of money. Even if you qualify for it, they have a max loan amount. And depending on where you're located in the country, that loan amount is going to change. They have a base loan amount and they have high cost areas. Here in the state of California, where I'm located, we're considered a high cost area. So our base loan amount, if you will, is higher than it is in other parts of the country. But with that said, the current base loan amount for anywhere in the United States is $726,200. Now, that's not the max you can qualify for. That's the max loan amount you can have. So if you were looking to buy, say, an $800,000 home, and you had the difference between that $800,000 and the $726,200 for your down payment, then you could still get a conventional loan, because conventional financing would allow you to go up to that $726,200. And on top of that, they actually have higher loan amounts if you're looking to buy units. So a 2-unit is actually going to have a higher base loan amount than a 1-unit, and then a 4-unit is going to have higher than a 3, as you can see from these numbers here. And in high cost areas, it actually goes up even higher. Now, if you're watching this going, what are units? Well, you can actually buy, say, a 4-unit building with conventional financing, where you rent out 3 of the units and occupy 1 as your primary home and still come in with the minimal down payment. Now, the caveat is you have to be able to qualify for that loan with those guidelines that we mentioned earlier in the video. But the cool thing is conventional financing will actually allow it, assuming that you qualify. So hopefully all of that made sense. I was able to break it down in ways that you could understand. But do me a favor, if you have questions, something I didn't explain clearly, something I didn't explain at all, maybe you have a question as a first-time home buyer or somebody trying to buy a home, do me a favor, put them below. I read all the comments. I'll go back and try to address and answer the question for you so that you have an accurate answer. But if you're still watching this, wanting more information on conventional loans, do me a favor and check out this video here.